Now let's deal with a unique case of the acquisition process. 90% acquisition, which is the same as previous one, but the 90% of acquisition and consideration is only $99,000. So if we calculate $99,000 divided by 90%, 100% consideration is only $110,000, which is lower than this fair value of net asset, 118,000. So $8,000 is discounted amount when the P company acquires 90% of this the S company. Okay. So how do we record this case? We are using the same name of account, as the previous one, and cash amount out. Cash out, how much? Right, 99,000. Also 99,000. There you go. Then we also have the same procedure in the consolidation adjustment. We have to manually remove the book value of the equity. So book value of equity, the same book value of common stock, additional paid-in capital, and retained earning, which is the same value of the book value. So we include this, we remove this, the book value of equity of S company. Then next, what is the next? Right, the differences when this fair value of inventory, PP&E, and franchise is greater than the book value. That is the differences, which is the same as before, the previous case. So the fair value of inventory, $1,000, $8,000 PP&E, and $3,000 of franchise, as you can see here. So $12,000 is the difference. So the sum of this book value of equity and the differences is the fair value of net asset. Fair value of net asset, again, the book value of equity plus differences in acquisition case. And then on the consolidation adjustment, this P company should remove an investment account, long-term investment account in S, because they will combine these two company in the consolidated financial statement. Okay, so we move 99,000, the same procedure. And then what is the NCI? NCI, non-controlling interest. Non-controlling interest, one more time, $99,000 divided by 90% times 10%. So $11,000. $11,000 is non-controlling interest that should be recorded on the equity section of P company of this the consolidated financial statement. But okay, let's just take a look at one more time. It's $110,000, which is 100% consideration, is lower than the net book value, the fair value of net asset, $118,000. In this case, goodwill, right? Goodwill, there's no goodwill. Goodwill is not generated. Instead, right, the gain account is created because now the P company purchased a less amount than the fair value of the net asset of S company. So the gain amount, how do you get it? This total minus this the 100% consideration. So the sum of this net book value, or the fair value of net asset minus total consideration of these two. So $8,000 gain. But you have to keep it in mind, this $8,000 is not the gain only for this parent company. Some portion, which is 10% of gain, is for the non-controlling interest. You have to keep it in mind when we create this consolidated financial statement. Now let's put all this journal entry into the working sheet with this adjustment procedure. So how much is the cash out? 99,000. And investment, how much is investment? Where do you put? There you go, the investment, 99,000. And then I'm going to include the difference, only the differences as we practiced before. So I put all this, the differences, and there's no goodwill. You have to keep it in mind that there's no goodwill. There's a huge difference. And then here, $99,000 removed because we are producing this consolidated financial statement where there's no investment. We assume that as if the merger case is 100% control. Okay, and then there's no okay, let me just sum up all this. Okay, and then there's no the additional the adjustment on the liability. Again, the liability on the acquisition process, there's no adjustment. Unlike these merger cases, we just combine this S and P liabilities as if merger, just as if merger. The reason why we are just manually combine these two is that S company is still operating. Okay, so next is now removing this book value of equity of S company. S company. Okay. Then what else? What else we have to do? Okay, the gain. Where this gain should go? Where should this gain go? Okay, non-controlling interest. Let's do the non-controlling interest. The gain increase, right? Gain increase the equity. Gain increase the retained earning. This non-controlling interest also is comprised of capital stock, additional paid in capital, and retained earning, which is a kind of equity account, but not for this P company, but others. But the reason why the company should present this net non-controlling interest, which is not the control of this P company, is that the P company is including all the fair value of net asset, fair value of net asset, fair value of asset, fair value of the liability of this 100% S company. That's why this consolidated financial statement should include the non-controlling interest 10% as well. So we put $11,000 there. Okay, but the gain here we have to increase 8,000 by 10%. The past 10%. Again, this non-controlling interest has 10% controlling interest of this all the gain, all this asset, all this liability. Okay, so we have to add this gain amount to $8,000, 10% of $8,000. In the same way, this gain increase also retain the earning through net income of this P company. So you should be increased by 90% because only 90% is control power of this P company from this acquisition process. So 7,200 should be increasing this retained earning of this P company as well. So let's combine this P and S for the asset account, increase debit, decrease credit. So we got it. Then there is no adjustment on the liability. Increase like this. Then the equity, you have to be careful considering minus this capital, manually removing, and plus this credit. So when I drag down, okay, so do you see we have a new retained earning and new non-controlling. which is different from the previous case. Okay, this case again, we create gain, not goodwill, so there's no goodwill account at all. Okay, so let me just clarify all these transactions, all this working sheet, some of these too. Okay, then we got it. And we want to just make sure that the sum of this liability and equity should be 502. Let me just fix this consolidated financial statement. Okay, so that's all. See you in the next video clip. Bye bye.